Yeah, guys. So Eurodollar is getting some traction at this moment. If we look at the chart, as I've mentioned, we did had a pullback to the levels of 80. This is pound dollar. There you go. To levels of 85 right here. 85 right there. So the pullback was there, and now retracing back all the way down to where I've mentioned already on last Tuesday, right here on this box. Okay, just been very easy to trade euro dollar on the last couple weeks, rallying all the way up to the levels of 1095, and now coming back to 1072. This is pretty much my trading perspective and what I'm looking to go with euro dollar. But there are some reasons why market is dropping. But what I want to pretty much focus on today, it won't be a too extensive webinar today, because there's two main things that I want to talk. First is the Bank of England interest rates decision, and second, of course, is the Federal Reserve interest rates decision that it has been done already. Okay, so it was done this morning. I think it was 4 a.m. in Australia. I was definitely not awake today. Yeah, guys, let me just turn it off this TV here. Just a second. Done. Otherwise, I can't concentrate myself. There's a TV in the office that it was on. So I was like, oh my god. All right. So Fed interest rate decision was done at 4 a.m. this morning in Australia time. Of course, it has kept as the same, but I want to show you something interesting here. All right. As I've mentioned, this is a public website, cmegroup.com. You can get the CME Fed watch tool, that is this one here. And look at how interesting. So last week, if I'm not wrong, or 2 weeks ago, this was 60%. All right. The 60% of the market was predicting a cut, a 25 basis points cut for the month of September. All right. But then what happened now is that 86.5% of the market is actually, oh, sorry, I forgot to turn it on my camera. There we go. Perfect. So now 86.5% of the market is expecting a cut on the month of September. If we move on to 7th of November, 60% of the market is expecting another 25 basis point cut. And then in December, 63% of the market is expecting another cut. All right. So pretty much the market is specifying 3 cuts for this year. All right. September, November, and December. Everyone was expecting 7 cuts on last December, going to June, going to January this year. To be honest, I was one of those persons. All right, I was waiting as well for 7 cuts because inflation was heading down and so on. But to be honest, I don't, you know, I don't think that inflation is coming lower as expected. But we did have yesterday the Fed, and that was today the Fed, and it was pretty interesting to see what they were saying about inflation. Okay, because if we look to the Federal Reserve here, PDF. Right. So they've changed some things here. All right. So let's have a look on the monetary policy. So recent indicators suggest that economic activity has continued to expand at a solid pace. Yes, that's good. Job gains have moderated, and the unemployment rate has moved up but remains low. Inflation has eased over the past year, but remains somewhat elevated. In recent months, there has been some further progress towards the committee's 2% inflation objective. All right, so pretty much they haven't changed much here, but they see that yes, inflation is moving lower to the 2% inflation objective of the committee. This is already something, okay? If they are looking at this and they're being able to see that inflation is coming lower to the 2% inflation objective, then they know that sooner or later they will be able to cut the rates. All right, this is pretty much the main thing happening at this moment. Then it goes. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee judges that the risks to achieve its employment and inflation goals continue to move into a better balance. The economic outlook is uncertain, and the committee, now it comes in, the committee is attentive to the risks to both sides of its due mandate. This is very hawkish, all right? Because I want to show you something. I'm going to have to go to the website again. Let's go and have a look at the June, all right? Let's put side by side here. This one comes here, and this one comes here. Okay, so exactly here and exactly here. All right, so at the July one, so today's one, it says the economic outlook is uncertain and the committee is attentive to the risks to both sides of its due mandate. I have my pen here. Oh yeah, there we go. Okay, so from here to here and from here to here. So the economic outlook is uncertain. Yes, they haven't changed anything. And the committee remains highly attentive to the inflation risks. Now they say, and the committee is attentive to the risks to both sides of its due mandate. We have something different here. What is different? Well, pretty much that they were trying to bring inflation down, but with the last reading on inflation being somewhat as expected, and yes, still high, but somewhat as expected, these two have a lot of work to be done in that. But they now are looking for the both sides of its due mandate, so inflation and the labor market. All right, so they want to bring this into better balance. And as they say, goals continue to move into better balance. All right. And now they say here, goals have moved towards better balance over the past year. All right. So that's pretty good. Pretty good. And now they say, all right, let me just note this down. Oopsie, sorry. Neutral. To dovish. In support of its goals, the committee decided to maintain the target range for the federal funds rate of 5.25% to 5.5%. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. They haven't changed anything here, all right? Pretty much all the same. In addition, the committee will continue reducing its holding of treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate instance of monetary policy, the committee will continue to monitor the implications of upcoming information in the economic outlook Committee would be prepared to adjust in stance of monetary policy as appropriate if risks emerge. And they say here as well, could impede the intentment of, yeah, it's pretty much exactly the same. So what they'll be looking on and into account a wide range of information is including the readings on labor market conditions, inflation pressures and inflation expectations, and of course, financial and international developments, right? So that's pretty much what they are looking to take the next decisions. Let me just check these notes out. Perfecto. So this is pretty much what they're looking into. Oh, no, I've lost it. Not a problem. Let me just come back again. Yeah. So in my opinion, all right, there are some interesting things that Jerome Powell have been saying. I'm going to just put it up here so everyone can watch it. I think my audio is sharing as well. Yes. So let's have a look on this.
Good afternoon. My colleagues and I will be.
Let me just find it up where it was.
Whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a. In terms of, I don't think of it that way. I think of it as.
Yep.
Chris Rugaber, Associated Press.
All right, pay attention in this question.
You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
All right. So Jerome Powell has been saying that he's not expecting any cool off on the job market. So what that means, what does that mean is pretty much that he is looking for higher NFP. All right. That's one thing that he given us a hint for tomorrow. And then this guy comes in and say, look, if you're not looking for lower jobs, then what will be the presumptive phases for you to cut the rates on next month?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of.
Again, he didn't say that on the last time of the presentation. We are in a good balance. We are balancing both of them. No, he was saying, yeah, yes, we are working towards the dual mandate. But now they are saying, yes, the dual mandate has come to an approach, and we have been on the into better balance between both of them. So Jerome Powell is saying that yes, inflation is coming down, labor market continues to go higher, and he is expecting that labor market will continue to go higher for another.
Question?
Yes, not a problem.
What does he mean by the dual mandate? What does that mean?
Okay, so when he says dual mandate, he's basically trying to bring inflation down at the same time as not bringing labor market down as well. So basically, letting the people getting employed, letting people have jobs, and reducing inflation, and at both time at the same time. So basically what he just said is he wasn't saying this before, but now he said is he's working on the dual mandate, and the dual mandate is working. All right, it's working now. The labor market continues to have higher readings, and the inflation is continuing to go decreasing. It's lower. So pretty much into an economy, this is what you want. All right, you want a lot of people working, so they can pay tax, but at the same time you want a lower inflation so they can live a life, and that doesn't affect the economy. All right, so let's continue to listen what he has to say, because there's another question I want to show you.
Go too soon and you undermine progress on inflation. Wait too long or don't go fast enough.
Yeah, so basically he's like, yeah, we can't wait too much, but we can't take actions too soon as well. because both of them can have tragedy on these options.
And you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like, again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
All right, so pretty much this was all he has to say about dual mandate. All right, so I want to show this one first. Now I want to show the inflation question. I think it was around 30 minutes.
I'm
so sorry if you ask the question.
I would just say that the question really is one of, are we worried about wage increases are still at a high level, unemployment is still at a low level, layoffs are very low in the labor market. And again, we are careful. We didn't want to go to
rates.
It might
of spending. You really do see now that policy is.
Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. It's to get into that policy is even a few months ago of spending, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off?
What was the question now? It was 30 minutes. I was pushing it.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously?
No.
That is
continuing. That's at each of our meetings and all of our decisions. Our focus is strictly.
I can't find it now.
But I do think that we're a consensus-driven organization.
All right. Anyways, so I can't. Oh, I have the transcript. Good, perfect. I can just search it up the inflation. Right, inflation questions. Oh, there you go. Here. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. So first thing is that he basically said, if the economy remains the levels where it is and persists going the levels where it is, then they will continue to maintain the fund rates as long. Just a second, guys. All right, so we can maintain the current target range for federal funds rates as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. There you go. All right. So basically, he said that they are ready to cut. And this is what is making the US dollar a little bit tricky to trade at this moment. All right, the US dollar is pretty hawkish at this moment, pretty bullish at this moment. As we can see, euro dollar is falling. All right, this is a 4-hour chart. Let me put it into the 15-minute. So euro dollar is falling. Okay, I do believe in a partial comeback towards levels of 109, 108.90. But this is just my expectations. All right. But now this is pretty much it for the Fed. Do you have any questions on regarding that?
Yeah. Is it sustainable for him to, keep balancing this two-factor mandate? Is it sustainable?
Yeah, it looks sustainable in some way, okay? Because that's exactly what he said just here. If the inflation becomes if the inflation comes to a faster pace going down, then what will happen is that they will be ready to respond, and that response would be cutting the rates. But if inflation continues to persist at where it is, 2.4, 2.5, sorry, it's not 2.5. It's 3.2. Oh, sorry. What's the inflation? Oh, yeah, 3.2. So inflation 3.2 continues on that level, 3 to 3.2. Then they would continue to maintain the rates higher for longer.
So then that means there's also the possibility that there won't be any rate cuts this year.
Exactly. So what do I think is he will be looking for the readings of August, okay? Because remember, we don't have a monetary policy committee, a Fed interest rates decision on August. The next one will be on September only. So we're gonna have to wait and see what the data we're gonna get this month. Most probably, we may have a stable inflation, and the thing is the inflation needs to come lower this month for them to cut next month. So if inflation don't come lower in August, then they're not going to cut on September. If the yep,
I don't think though. I don't think inflation will come lower because of because those guys have been employed now, so they have more money to spend, which will cause more inflation. So I think it will come either like a little bit higher or a little bit lower, but there won't be any cuts. That's what I think, because employment is high.
Yes.
So people have money to spend.
That is
so
correct.
Once they spend more, that is higher inflation. So there's a possibility there won't be any cuts at all, because now we're coming to the final quarter of the year, and there's Black Friday, there's all these different holidays,
Christmas and so on.
So,
yeah.
I don't think there'll be any cuts probably till next year.
Yeah, I do believe at least one. I do believe in at least one cut in maybe November, but it just for the September cut, I would definitely had to see how inflation numbers will come and how the labor market will come, how NFP will be on Friday. Otherwise, if NFP comes higher and the inflation comes as expected or a bit higher, then they're not going to cut on September. But if it comes lower inflation, is still with a higher NFP, most probably they will continue to they will do a cut, even if inflation, even if the labor market, even if the NFP comes higher, because we can't forget that the unemployment rate is still at 4.1%. Yes, it is low, but it's high at the same time for this period of moment. But you're not wrong on saying that yes, people are with money and they are ready to spend on Thanksgiving and Black Friday and all of the other other things. Let me just search it up a really silly question. What are the month that most of the people make
If
birthday.
possible, the cut will be in probably December, because people will be saving up to spend most of the money then.
See, August
Yeah.
is overall the most popular month for birthdays, which makes sense. A late August birthday means December conception. Cold weather, snow, romantic fires, and holiday parties seems to create just the right equation for beginning of human many seasons. So yeah, August is probably it's going to be a lot of people buying gifts, and if people
Mm,
buy a gift, then inflation goes up. So
mm,
higher retail sales and so on. So look, it's a silly question, but most probably we can be right on this trade. Now,
mm,
how can we express this into the market? There's some ways. You could short euro dollar until the levels what I've mentioned. Sorry, let me just change this to the 4 hour again.
the biggest one is probably the pullback.
So,
It would,
sorry.
because there'll probably be a pullback before euro dollar goes more like lower.
Possibly, yes. I'm looking at the levels of 107 200
Mm,
for the main target, but the first target was here, and then the second one
mm,
was here, and now the third one is on here. So most probably, yes, we may see a pullback. But look, I don't want to be, pessimistic on the short side, but we still have a target to be hit here. And if we break through here, as we just did, and then come up and break through here, then yes, we may have this as a target. All right, so something like on this, so maybe come back now, break through there, come back, and then come back here. So this is this can potentially happen as well. All right,
mm,
but it's very unlikely. I think we may
yeah.
continue to descend towards
Mm,
this level. Okay. Much more closer to here than actually, going all the back down.
yeah.
Right. So this is pretty much it for Europe, US dollar, and USA. We do have at 9 p.m. on Sydney time, the UK, the Bank of England monetary policy vote for the interest rates decision. And we will continue to have as well the non-farm productivity, initial jobless claims, the S&P Global US Manufacturing PMI, and what else? Yeah, ISM Manufacturing PMI and ISM Manufacturing prices. So, having all of these together, right? We're not that far away. We're a few minutes away, actually, a few hours away from the UK. My expectations are on a cut, all right, on a cut of around 5 votes to, 4 votes to unchange and 5 votes to cut. So one person will be probably the one that will be likely to make the the cut, another 25 base points cut. With that, we can see the pound going lower. Okay, with that, we can see the pound going lower. I think there is a very simple trajectory. All right, very simple trajectory to see that the pound would come at this level, and I've called it exactly this level. All right, perfect. Just here. So we've just break this button again, and we are very, very quickly ascendanting to the lower parts of the chart. The main end goal here for the pound is pretty simple. Okay, inflation has been coming lower. Inflation has been very, very on a sustainable approach. There is no other reason why they shouldn't cut. There's no other reason why they shouldn't cut. labor market, yes, it's it's another story there. It's a bit tricky, but still pretty good, pretty well done scenario for UK. Now, if we look to JPY, for instance, yes, they've hiked 25 basis points, as expected. I've mentioned on Tuesday night, I've mentioned to everyone, yes, they will hike, and USD JPY just continue to drop like no tomorrow. So from here all the way to the top to 162, now all the way to here. And I've mentioned this would be the target. Yes, it got hit. I don't see any other target on my opinion. All right. Oh, sorry. The main target was here. This was the first, and then the main target is down there. Sorry. So the main target is this first target would be this box, and then the second target would be this one. Because remember what I've mentioned it, when we have this, then we have the first target on here, and then the second target on here. Okay, so this is the main target for the USD JPY. We may continue to see even more deeper corrections and deeper move. Now, would I continue to long? Would I buy USD JPY? I don't think it's the time now to long USD JPY anymore, just because that we are seeing the Bank of Japan being much more hawkish in this year than it has been in the past 30 years. So there is a continuation of a down move on USD JPY to remain pretty high chance, right? But now, if they say, look, this is it, we're not gonna, we think that this is it, we're not gonna hike interest rates anymore, we are very solid already, we don't need anymore, then yes, we will see USD JPY coming back higher. But most probably we will continue to see a deeper moves on USD JPY. All right, this is it for today. I don't have much. I just want to talk about the Fed and as well about the UK. Talking about NFP, I've mentioned already, most probably we will be able to see a lower NFP, in my opinion. But, Jerome Powell has been stating that most probably we will see a higher NFP. I just don't believe on that, because we still have higher unemployment rate at 4.2, 4.1, 4.2, around that levels. And this is pretty high. At 4%, it's pretty high. These levels should be at 1, 1.5, maximum 2. And it's not looking great. But if it gets higher, then yes, euro-dollar will definitely, continue to dump very, very quickly. And same with the pound-dollar as well. All right, guys, thank you so much. Thanks, Casey. Hopefully you guys can have a awesome weekend ahead, and I catch up with you all on Tuesday next week. All right, guys, thank you. Bye-bye.